Risk is what's left when you think you've thought of everything. Most traders enter the market believing they're prepared until the market shows them how unprepared they truly are. It's shocking how many traders lose their entire account not because of bad strategy, but because of unmanaged exposure. A massive percentage of new traders blow their first accounts within weeks. Most losses come from using oversized positions, and the majority of traders fail not due to bad market timing, but due to emotional decisions under pressure. Risk management is the foundation of a trader's survival. Without it, knowledge collapses, discipline fades, confidence breaks, and strategy becomes meaningless. This is where the journey begins, the raw truth that every professional trader learns early and every struggling trader learns painfully. Risk management is not a tool. It is the psychological firewall between you and self-destruction. It protects your emotions, your capital, your identity, and your decision-making. It is the invisible shield that professionals rely on long before they care about entries or indicators. Every trader believes they already understand risk management, but most treat it as an optional step. That's where the first crack forms, because the question isn't whether you know risk management, the question is whether you live it, whether you breathe it, whether it's part of your trading identity. Mark Douglas repeatedly emphasized that trading is a game of managing uncertainty, not predicting outcomes. To think like a professional, you must accept that the market doesn't owe you safety. You create your own safety through structure. So why do traders ignore it? Because risk management feels slow, it feels boring, it feels restrictive, it feels like it limits potential profits. This is the trap almost every new trader falls into. It's a psychological illusion created by excitement, hope, impatience, and the craving for fast success. The mind convinces you that more risk equals more opportunity, but the professionals understand the truth. More risk usually equals more damage. The real opportunity is not in big trades, it's in consistent survival. Here's the pattern interrupt. Most traders don't blow their accounts because of the market. They blow their accounts because of themselves. They underestimate volatility. They overestimate their emotional stability. They refuse to accept losses. They treat the market like a challenge to be conquered instead of a system to be respected. The turning point begins when you realize that risk management isn't limiting you, it's freeing you. It frees your mind from fear. It frees your emotions from chaos. It frees your identity from desperation. Risk management is the true definition of confidence. It means you know that no single trade can break you. It means you operate from clarity rather than fear. It means you make decisions from logic rather than panic. Brian Tracy's principles of personal discipline apply perfectly here. Successful people build systems that protect them from their own weaknesses. You protect your future by managing your exposure. You protect your identity by managing your reactions. You protect your consistency by managing the downside before chasing the upside. Let's dive into what risk management truly is. It's the art of protecting your capital so your strategy has enough time to work. It's the process of controlling how much you're willing to lose so you can continue trading tomorrow. It's the mental discipline of choosing safety over excitement. Professional traders think in probabilities, not in fantasies. They know that losses are not enemies, they're expenses. And like any business owner, the trader who survives is the trader who controls costs. So what is the psychological meaning behind risk management? It means accepting that you cannot control outcomes, only behaviors. It means embracing the reality that uncertainty is permanent. It means developing the emotional maturity to take small losses without frustration. Ed Seykota showed the world that long-term success is built not on prediction, but on disciplined exposure. He proved that traders don't blow up because of bad trades, they blow up because of refusal to respect risk. Here's your emotional transition. When you truly accept risk management, something powerful happens inside you. You stop chasing perfect entries. You stop trying to predict every movement. You stop fighting the market. You become calm. You become patient. You become strategic. Your decisions slow down. Your clarity increases.
You operate with the mind of someone who expects volatility, respects uncertainty, and acts with precision. This is the beginning of your professional identity. Jesse Livermore's experience reinforces this transformation. He learned, lost, rebuilt, and evolved repeatedly, and every time he returned stronger because of one principle: control your downside, control your exposure, control your emotional reactions. Livermore showed that even the most brilliant strategy becomes useless without the ability to manage loss. Professionals aren't defined by their wins. They're defined by how well they protect themselves during losses. Neuroscience backs all of this deeply. Your brain creates neural pathways based on repetition. When you consistently practice risk management, you strengthen circuits of emotional regulation, calm decision-making, and long-term thinking. You reduce the emotional spikes that cause revenge trading. You reduce the internal noise that causes impulsive entries. Your mind becomes conditioned to pause, evaluate, and choose the safer path. This is not just psychological, it is biological evolution. And here's the identity shift. You are becoming someone who does not fear the downside. You understand it, you prepare for it, you accept it. You protect your mind before protecting your money. You trade from a place of control instead of chaos. You build an identity around longevity, not excitement. This is how professionals think. They protect their capital first, and the profits follow naturally. Risk management isn't the side story, it's the main story. It's the foundation that allows your strategy, discipline, and psychology to grow. And by committing to understanding it deeply, you immediately distance yourself from the majority of traders who ignore it. You step into the mindset that separates survival from collapse, consistency from chaos, professionalism from emotional gambling. This is where your journey begins, the first step toward thinking like a disciplined, strategic, long-term trader. The mind that respects the downside builds the future upside. And now that your foundation is set, we move deeper into the world of risk, the world of structure, and the world of protecting your trading future.
Risk management begins with one truth that most traders ignore: structure creates freedom. Every part of your trading life becomes calmer, clearer, and more controlled when structure is present. Without structure, your emotions become the decision maker. With structure, your principles make the decisions for you. This shift is what separates the professional mindset from the unstable mindset. The more structure you build, the safer your trading future becomes. Not because the market becomes predictable, but because your behavior becomes consistent. Most traders think risk structure means stop-loss levels or position sizing formulas, but this is only the surface. The deeper psychological structure comes from knowing why you risk, when you risk, how much you risk, and what you expect emotionally every time you enter the market. The amateur sees risk as a threat. The professional sees risk as a tool. And tools become powerful only when used with discipline and repetition. Structure is how you transform risk from something emotional into something strategic. Before we go deeper, here's a pattern interrupt. Traders don't need more indicators. They need more boundaries. They need more guidance for their mind, not for their charts. Because without mental structure, even the best technical setup collapses under emotional pressure. This is why Mark Douglas taught repeatedly that trading is not about predicting price. It's about organizing your internal processes so that probabilities can play out without interference. Structure is the psychological seatbelt that keeps you safe even when the market swerves violently. So what exactly is risk structure? It's the invisible architecture behind every decision you make. It's the system that determines how much heat you can handle, how much emotional volatility you can absorb, and how long you can stay in the game even when conditions become difficult. Risk structure is knowing your maximum pain long before the trade begins. It's knowing how you will behave when the market moves against you. It's the mental plan that guides your actions when emotions try to hijack your logic. This is where Ed Seykota wisdom becomes vital. He believed in designing systems that were stronger than human emotion. His entire trading philosophy was built on structure that forced discipline. He didn't rely on willpower. He relied on rules, boundaries, and automated processes that removed emotional distortion. Sakota understood that humans are inconsistent, but structure makes them consistent. And the more consistent the trader, the more predictable the results. This is why professionals don't trust emotions, they trust systems. The emotional transition begins when you understand that structure isn't limitation, it's liberation. You stop feeling overwhelmed by volatility. You stop feeling attacked by losses. You stop feeling the pressure to react quickly. Structure slows your mind and stabilizes your reactions. It creates a calm internal rhythm that matches the behavior of long-term traders. Instead of drowning in uncertainty, you begin navigating it like someone who expects storms but never fears them. Now we move into the deeper meaning. Structure is also emotional risk control. It's the commitment to protect your mental state just as much as your capital. Every trader has a limit, a point where stress becomes distortion, fear becomes paralysis, greed becomes aggression, and confidence becomes instability. When you build risk structure, you acknowledge those limits, you respect them, and you design your trading plan to keep you safely inside those boundaries. This is not weakness, it is wisdom. Brian Tracy's principles of self-discipline strengthen this concept. He taught that predictable behavior comes from predetermined systems. In trading, this means you prepare your risks before you prepare your trades. You define your exposure before you define your strategy. You choose your boundaries before you choose your entries. Tracy understood that systems replace emotion, and this single shift turns chaos into consistency. Risk becomes less about fear and more about responsibility. Here's another pattern interrupt. Risk structure is not for bad days, it's for good days. Because good days are when traders become reckless, careless, overly confident, and emotionally inflated. Good days create the illusion that you can handle more risk than you truly can. This is how accounts are destroyed. Professionals protect themselves on good days, so they survive the bad days automatically. Structure prevents emotional overconfidence from transforming into financial disaster. The identity shift deepens here. You begin seeing yourself as someone who builds systems, not someone who reacts. Someone who respects boundaries, not someone who tests them. Someone who chooses clarity over excitement, patience over pressure, and stability over impulse. When your identity aligns with structure, risk management becomes natural. You start thinking like someone who doesn't fear the downside because you've already built the protection for it. Jesse Livermore's experience reinforces this truth with real history. He documented how traders lose more from lack of boundaries than from lack of intelligence. Every major mistake in his career came from moments when he stepped outside his own rules, when he abandoned structure, when he allowed emotion to override discipline. And every major success came when he followed strict risk limits, even when the market tempted him to break them. His life is a blueprint for why boundaries matter more than brilliance. Neuroscience gives scientific weight to all of this. Your brain can only handle limited emotional stress before it begins making irrational decisions. Risk structure reduces cognitive load. It reduces emotional spikes. It reduces the noise that leads to impulsive trading. When your limits are predetermined, your brain doesn't need to negotiate with fear or greed during the trade. This preserves clarity and strengthens neural pathways associated with discipline and long-term thinking. Structure literally builds a trader's brain. And here's the emotional conclusion. Structure is your anchor. It gives you steadiness in chaos, confidence in uncertainty, maturity in volatility, and strength in difficult moments. The deeper your structure, the calmer your mind. The calmer your mind, the better your decisions, and the better your decisions, the more consistent your results. This is the path from unstable trader to structured professional. This is the transformation that turns risk into power.
Risk management stops being theory the moment you enter a trade. This is where your structure is tested, where your emotions are exposed, and where your identity as a trader becomes visible. Execution is the bridge between planning and performance, between intention and reality. Most traders collapse at this stage because they are prepared intellectually but unprepared emotionally. Professionals succeed here because their risk execution is a behavior, not a reaction. It is a trained response, not an emotional impulse. To understand professional execution, you must first understand why amateurs fail. They fail because they execute risk emotionally instead of structurally. They adjust stops out of fear. They increase size out of greed. They close trades early out of anxiety. They add to losing trades out of denial. These emotional reactions turn risk management into risk destruction. Mark Douglas warned that behavior under pressure decides your trading destiny. The market doesn't test your strategy, it tests your emotional discipline. Here's a powerful pattern interrupt. Execution is not the moment you click. Execution begins long before the trade. It begins when you decide how much you are willing to lose. It begins when you define your emotional tolerance. It begins when you choose your boundaries. By the time the order is placed, the professional trader has already managed the risk. The amateur tries to manage it after the order is live, when emotions are strongest and clarity is weakest. So what exactly does proper risk execution look like? It looks calm. It looks measured. It looks unbothered by fluctuations. It looks detached from the outcome. Professional execution is built on predetermined steps that remove emotional negotiation. There is no guessing. There is no hoping. There is no adjusting based on fear. The rules are followed, the risk is fixed, and the outcome is accepted. This is not coldness. It is freedom, because the mind is no longer fighting the market. Ed Seykota philosophy reinforces this beautifully. He designed systems that forced high-quality execution even on bad emotional days. His approach was simple. If the rules say exit, you exit. If the rules say reduce size, you reduce size. If the rules say do nothing, you do nothing. He believed that execution must be automatic, almost ritualistic. This eliminates hesitation, panic, and second-guessing. The more automatic your execution becomes, the more consistent your results become over time. Execution is also about emotional energy. Each trade consumes mental resources. Each loss requires emotional recovery. Each mistake creates psychological friction. Professional risk execution minimizes this energy drain by reducing unnecessary decisions. When your risk is defined, your stop is placed, and your expectations are realistic, the trade becomes emotionally lighter. You're no longer wrestling with every candle, every pullback, or every small fluctuation. You conserve emotional strength for high-quality decisions instead of wasting it on noise. Now you enter the emotional transition that separates amateurs from professionals. The amateur enters the trade and becomes attached to it. They feel the movement as if it is connected to their self-worth. Every tick creates excitement or fear. They merge their identity with the result. Professionals do the opposite. They stay separate. The trade is just a trade. It is not them. It is not their value. It is not their future. This emotional separation allows them to execute without mental distortion. This is where the concept of risk as identity becomes powerful. When you identify as a trader who respects risk, your execution naturally follows that identity. You don't break rules because that would contradict who you believe yourself to be. You don't oversize because that would violate your internal standard. You don't panic because your identity is built on discipline, not emotion. Brian Tracy's work on self-concept explains this. Behavior always follows identity. The trader you believe you are determines the trades you execute. Jesse Livermore's experience gives this idea historical legitimacy. He repeatedly documented that execution errors were never about skill. They were about emotion. When he executed with discipline, his results were extraordinary. When he executed with emotion, even brilliant analysis led to losses. His success wasn't built on prediction, it was built on behavioral consistency. The more he respected his risk rules, the more he protected his capital, and the more he allowed big moves to unfold without interference.
Neuroscience provides the final layer of understanding. Your brain reacts to market movement with stress signals that can distort perception. Pressure increases the activity of emotional centers and decreases logical processing. This is why execution becomes harder the longer you wait to act. Professionals avoid this trap by acting immediately according to rules, before emotional activation intensifies. This strengthens neural pathways associated with confidence and reduces pathways associated with panic. Over time, the brain becomes conditioned to execute calmly. Execution also requires embracing uncertainty. Professionals accept that they cannot control the outcome. They cannot control volatility. They cannot control how long the trade will take. What they can control is how they enter, how they size, how they place stops, and how they exit. This acceptance of limited control creates psychological stability. Amateurs try to control everything and create stress. Professionals control their behavior and create consistency. As you internalize this mindset, something powerful happens. Execution stops feeling heavy. You stop overthinking, you stop forcing, you stop reacting emotionally. Instead, you begin operating with clarity and calmness. You act because the plan says act, not because emotion says act. You hold because the plan says hold, not because fear says hold. You exit because the plan says exit, not because panic says exit. You shift from emotional trading to structural trading. And here is the closing transformation. Execution becomes your identity. It becomes who you are. It becomes natural, automatic, and reliable. You begin behaving like a professional trader even before your results reflect it. And once your behavior stays consistent long enough, the results eventually align. Professional execution is not a destination. It's a habit, a rhythm, a psychological practice.
Risk management is not just mathematical, it is deeply emotional. You can have the strongest plan, the clearest rules, and the most logical structure, yet still collapse if your emotions are unstable. The truth is simple. Your feelings about risk determine how you behave under risk. This is why emotional risk control becomes the core of professional trading. Without emotional stability, strategy becomes fragile. With emotional stability, even a simple strategy becomes powerful. Emotional control is the invisible engine behind every professional trader's success. To understand emotional risk control, you must first understand why emotions intensify during trading. The mind interprets market movement as personal danger. A losing trade feels like a threat. A drawdown feels like failure. A missed move feels like incompetence. These interpretations create emotional pressure long before the trade reaches any logical threshold. Neuroscience shows that emotional centers activate faster than rational thought. This means emotional reactions begin before you can even process the chart. Professionals know this, and they build systems that protect them from their own emotional speed. Here's a pattern interrupt. You don't feel fear because the market is dangerous. You feel fear because your expectations are unrealistic. When you expect smooth trades, volatility feels painful. When you expect immediate results, delays feel threatening. When you expect perfection, normal losses feel catastrophic. Emotional pressure is not caused by price movement. It is caused by the internal story you attach to that movement. Professionals change the story, and the emotion changes with it. Emotional risk control starts with awareness. Most traders suppress emotion, believing that ignoring fear or denying excitement will make them disciplined. It never works. Suppressed emotion becomes stronger. Professionals do the opposite. They observe emotion. They notice the tension in their shoulders. They notice the racing thoughts. They notice the urge to break rules. This awareness weakens the emotional grip. It creates mental distance, and in that distance, logic returns. The emotional transition deepens when you start accepting your emotional patterns instead of fighting them. Fear is not your enemy. Greed is not your enemy. Anxiety is not your enemy. These emotions are signals. They reveal your limits, your expectations, your psychological vulnerabilities. When you interpret them instead of resisting them, you gain insight into your behavior. Ed Seykota understood this deeply. He believed that emotional stability came from understanding your internal triggers, not from denying them. His success was built on emotional honesty. Now we move into the identity part of emotional control. Professionals see themselves as calm operators. They identify as disciplined individuals. They build the image of a trader who remains steady even in uncertainty. This identity becomes a psychological anchor. Brian Tracy taught that self-concept governs behavior. When your identity is built on stability, your actions naturally move toward stability. You exit without hesitation. You reduce risk without panic. You hold without emotional attachment. You behave according to who you believe you are. Jesse Livermore's experiences give emotional control a historical blueprint. He wrote repeatedly that emotional storms destroyed more traders than bad markets ever did. His greatest losses came during emotional overconfidence and emotional panic. His greatest gains came when he was calm, patient, and detached. Livermore proved that emotional neutrality is not optional, it is essential. When emotions rise, decision quality collapses. When emotions stabilize, clarity returns. His life is a reminder that emotional stability is not just helpful, it is survival. Let's go deeper into how emotional stability works in real time. When price moves against you, your mind enters survival mode. It exaggerates danger. It amplifies fear. It creates urgency. This is why amateurs close trades too early or break their rules. Professionals do not eliminate this reaction. They manage it. They pause. They breathe. They reconnect to their structure. This pause interrupts the emotional spike. Neuroscience calls this disruption the emotional reset. It gives the brain time to activate logical circuits before emotional ones take over. Here's another pattern interrupt. Emotional control is not staying calm all the time. That is impossible. Emotional control is recovering faster every time emotion rises. It is the ability to regain clarity while volatility is happening. It is the ability to return to structure even when your heartbeat increases. Professionals bounce back quickly. Amateurs stay trapped in the emotional wave. Emotional dominance is not perfection, it is recovery speed. As emotional control strengthens, your relationship with risk transforms. Risk becomes less threatening and more predictable. Drawdowns feel manageable instead of catastrophic. Losses feel normal instead of personal. Missed trades feel educational instead of painful. This emotional neutrality creates a stable internal environment, and stable internal environments create consistent external results. Most traders try to change their trading outcomes. Professionals change their emotional responses, and the outcomes follow naturally. Your identity continues evolving here. You begin seeing yourself as someone who stays composed even when conditions shift. You begin trusting your ability to handle pressure. You begin valuing patience more than excitement. This identity shift builds psychological resilience. It keeps you grounded, it keeps you disciplined, and it strengthens your belief that you can perform even during difficult periods. This belief is the foundation of long-term trading mastery. As your emotional control deepens, you stop needing reassurance from the market. You stop needing perfect conditions. You stop needing constant confirmation. Your confidence becomes internal. Your stability becomes self-generated. And this is the moment where trading transforms from emotional chaos into structured performance. You no longer react to every fluctuation. You respond only to your rules. This is the emotional power of a professional trader.
The moment a trader finally touches real mastery, something shifts inside them. Something subtle, something almost invisible to the outside world. They don't trade faster. They don't chase harder. They don't scream confidence. Instead, they move with a quiet certainty that feels unshakable. This is the stage where risk management stops being a rule and becomes a personality, a way of living, a mental operating system. And this is where your trading life will change forever. There comes a day when you realize the market does not reward the one who wants to win the most. It rewards the one who can survive the longest. This truth hits differently when your confidence rises not from your results, but from your control. You no longer fear the chart turning against you because you've prepared for that moment long before the entry. Douglas called this state the probabilistic mindset, the world where you finally stop expecting certainty and instead start managing uncertainty like a professional. Most traders never reach this stage because they are possessed by the illusion that more knowledge equals more safety. But pro traders know the real safety comes from something much deeper: the ability to walk into the unknown with a structure that protects you from yourself. When you step into this mindset, the obsession with predicting stops, and the obsession with protecting begins. There is a powerful identity shift that happens here. You stop calling yourself a trader who tries to win and start calling yourself a risk manager who trades. Livermore lived by this transition. Sakota built his entire style on it. Neuroscience confirms it. The human brain reduces emotional activation when it believes it is in control of risk. Your mind becomes calmer, your decisions become cleaner, your discipline becomes your edge instead of your burden. The world will tell you that trading is about strategy, but every experienced trader in the UK, the USA, and beyond eventually discovers the same truth. Strategy is the doorway, but risk management is the home. You might visit a strategy for a season, but you live inside your risk rules. This is the point where your identity becomes untouchable, because when your risk is controlled, nothing the market throws at you can break your self-belief. Let's interrupt the pattern here. Feel this for a moment. Imagine waking up tomorrow with total emotional clarity. No stress about taking a trade, no anxiety about missing one, no fear when the chart moves against you. Because you know your risk is locked, your exposure is controlled, and your account is protected. That version of you is real. It is close. It is already forming inside you as you understand this script. But mastery requires that final transformation, turning risk management from a rule book into a habit loop. This is where identity takes over. You stop forcing discipline, and discipline starts flowing automatically. Brian Tracy always taught that habits create destiny. In trading, habits create survival, and survival creates freedom. Once your risk habits become automatic, your emotions stop fighting you. They start serving you. Professional traders treat every trade like a business decision. They review their risk before they review their setup. They check their exposure before checking the candle. They walk into the market like a pilot running pre-flight checks, calm, structured, unemotional. This is not boring. This is elite. This is the behavior of a trader preparing to last longer than everyone who is trying to get rich by Friday. And here's the emotional turning point. You begin to love the feeling of safety more than the thrill of danger. The dopamine no longer comes from oversized trades. It comes from controlled ones. You celebrate a clean loss because you followed your system. You celebrate a small win because you earned it the right way. You celebrate the days you did nothing because that restraint protected your future. The ego dissolves, the professional emerges. Every successful trader eventually understands that risk management is not only a financial tool, it is a psychological foundation. It is the structure that keeps your confidence alive. It is the fence that keeps your impulsive self from damaging your future self. The more you respect risk, the more the market respects you. That's why Douglas always said the market rewards the disciplined, not the emotional. This is your final step, the moment you stop fighting yourself and start engineering yourself. You build an inner environment that supports consistency, protects your account, and strengthens your identity. You begin crafting systems, routines, checklists, boundaries. But more importantly, you build internal rules. Rules that keep you aligned even when no one is watching. Rules that guide you even when the chart is chaotic. Rules that protect the trader you are becoming. And slowly, almost silently, something powerful begins to happen. Your confidence no longer depends on winning streaks. Your mood no longer collapses after losses. Your self-esteem no longer swings with the candles. You stand firm because you trust the one thing you can control, yourself. Risk management becomes your backbone, your armor, your advantage. And once that transformation happens, the market can shake, but you won't. So here you are, at the end of this journey, but at the beginning of your evolution. You now understand the mind, the habits, the psychology, the emotional regulation, and the identity of a risk master. What happens next is not about knowledge, it's about commitment. If you choose to live like this, the entire trajectory of your trading will shift. The losses that once destroyed you will barely dent you. The wins that once excited you will now feel normal. And your future will no longer be built on luck, but on discipline. This is where you step into the world of true professionals, the world where risk is not feared, but respected, not avoided, but mastered, not hated, but embraced. The world where your trading career becomes sustainable, stable, focused, and powerful. You now know exactly what to do, who to become, and how to operate. If you're ready to transform your trading mindset, subscribe to Mind for Trade. We share insights, strategies, and psychological tools from legendary traders to help you survive, thrive, and dominate the markets. Don't wait for your emotions to destroy your account. Take control now.